there are mainly four things that I want to cover today, and these are very basic things. So the first thing that I want to start off with is accounting. So if you ask me what is accounting, and if you look at that textbook, please close that. So if you are looking at these textbooks, you will find it is the process of the procedure of the communication of the blah 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 blah, blah, right? Back up, back up, back up, back off. So accounting is everything in life. Okay, you're going to a shop, you bought something, right? You are recording it, you have accounted for it. Okay, it is the way in which you are keeping your books, whether it is finance or whether it is how many of you maintain a journal, a diary? So whether it is a financial activity or whether it is an operating activity, right? So you keeping a track of everything, that is accounting. But we are talking about, since you all will be working for firms that require accounting on a very high scale, we are talking about accounting on a different level. We are talking about basically, I would like to divide this into three types. Okay, operating accounting, financial accounting, management accounting. Okay, so accounting is not just you keeping the books, but it is the way in which you are recording these happenings. Okay, these happenings, what I would call as transactions. So remember this word, transactions. In every place we will have transactions and we will have events. You going to a shop and you asking for the price of a MacBook is not a transaction. That is an event. You went there and you inquired for the price. You did not buy it. But if you buy it, that becomes a transaction where there is financial activity taking place. That becomes a transaction. So when you are accounting for things, you will never note down events. You will only note down transactions. Okay, so and so this is basically how different types of accounting, right? You have finances, which is basically these companies, CFOs, executive level guys. So these guys, especially the financial team, this team, and our subject is corporate financial accounting. So I want to focus on this. Okay, so briefly I will introduce you though. Okay, so every company will have a Securities and Exchanges Commission. So a company will so when you're talking about a company, they are not just buildings and processes, right? How many of you look at the newspapers, you look at the stock readings, you look at the stock demat accounts, your parents, your brothers, your siblings, sisters? So this is trading, right? So every company, when it has a profit, okay, it there is something called SEC, Securities and Exchanges Commission. Every country will have this, okay? And these companies which are listed on the public shares, which are listed on this, they have to report their earnings, profits, etc. to this SEC. That's a rule. That's a rule. Okay. And most of this accounting, if you have noticed, there are some companies which if you can notice on their websites, there are some companies that have placed their say quarter 3 earnings, quarter 4 earnings. They have posted their earnings. Okay, and there you will find something called gap. Okay, and gap is not a gap analysis. It is generally accepted accounting principles. Generally accepted accounting principles. Most of the time, when you're preparing financial statements and calculating stuff, you will follow the gap principles. Okay. Okay. And uh, accounting these days, you have a lot of softwares also. You have Tally, you have some other things. Okay. And CPA is your certified public accounting. That is an MCQ I'm gonna ask you. like nobody would answer it. So let us dig. I want to dig into financial accounting now. Financial accounting, every company will have to manage its finances. So let's say I am starting a company. Okay, I cannot start a company without any finance, right? So the first step that I will be taking is the activity, these are called business activities. Business activities. So the first thing that the first activity that I'll perform is financing activity. So in financing activities, what will I do? I will manage to get some money for the firm. Okay. How can I do it? How can I do it? I can take a loan. Okay. So the people who give me the loan, they are called lenders or creditors. And the money that I owe them, that comes under something called liability. Liability. So this is something that I owe. I cannot escape this. I cannot escape a liability. I have to do it. So the second method of getting money is, yeah, we were just talking about shares. The second method in which you can get money is selling your company's stock. So the company's net value is divided into common stock and it is put up for sale. I can price my shares so that if you sell these many shares, I'm expecting this much of money. So based on my company's worth, my share is priced and I can sell these and I can earn some money in return. So the shares that I sell, it is basically equity of my company, right? This is called shareholders equity. That is your common stock, and you are getting money through this, right? So at the end of the year, when you publish your reportings, when you publish your earnings, profits, etc., etc., you will have profit or loss, right? So say you are lucky and I'm lucky and I've gotten some profit. So let's say I've got in the year 2018, I've got 2 lakhs profit on the company. So if I choose to give back some of that money back to the people who have invested in the firm, that amount is called dividends. So out of 2 lakh rupees, if I am giving 50,000 back to the people who have invested, that 50,000 is the dividend for the company. So remember all these terms, but as you start preparing financial statements, you'll be good. These are simple things. So this amount is called dividend. Okay, but the remaining 1,50,000 I'm keeping with myself, right? Which is the company's money. So that is called a retained earning. We'll come to that later. Okay. So the next activity that I will do, I have financed. Now come out of the examples. Come out of the examples. I have done financing activities. Now I have the money. Now I have to start. Now I have to start. Start what? Start doing the work. Start building the company. So to build the company, I'll have to get some things. I cannot do everything on my own, right? So I will do something called investing activities. So examples of investing activities would be uh, you buy, let's not say buy, it's tough to do that. You leased some land, okay, or some building. So you're leasing some things. So this is an investing activity. You're investing your money, whatever you have gotten from either loans or common stock, into, you're getting some land, you're renting some buildings, and then you're buying some laptops. If it's a software firm, you're buying some machinery, etc., right? Or and then you are also hiring workforce. Okay, so all these things come under your investing activities. So your laptops, your machinery, all these things, these are your assets. These are the things that the company owns now. So you own the company, okay, and the company, you have bought these for the company. So the company owns these things, whether you're leasing, buying land or buildings, or you're buying machinery, whatever. Workforce, so these are your assets, okay. These are considered assets, and this is liability, assets, okay. Although hiring workforce, that is an investment activity, you generally, the workforce is not considered an asset of the company, because the company does not own the people, okay. It's only we can't own people, apparently. So the last thing is the final thing. I have gotten the loan, I have gotten the equipment that I need. So now what do I need to do? I should start operating. So the last thing is, and the most important thing is, operating activity. So in operating activity, this is where I actually start manufacturing things. Okay, this is where I create, I sell, and I make money. Okay, so what do I have now? I uh, I spend money. I spend money. Say somebody comes up and says, "You bought a laptop. It's not enough. I want this Tally software, or I want something else. I want Wi-Fi. I want internet." So I'm spending money there. Okay, these are all my expenses. Okay, and then when I'm selling that specific product, I'm obviously selling it for money, and whatever I'm getting, that is called revenue. Revenue. So how do you calculate profit? So whatever revenue you are getting, remove it from the expense. That is your earning. This is your, let me call it income first. Okay. So all your expenses removed from all your revenues will give you a net income. Okay. But life is not that easy. So when I'm calling about all my expenses, if I have to pay back something to these creditors right now, I'm doing it. All of that is covered there. So whatever is my earning is after all my expenses have been removed, completely removed. So that is what I'm calling when I'm saying earning. So once I remove, net income. So my net income is all my uh, expenses removed from my entire earning. So this is my net income, and then I have to pay tax, right? Tax. After paying tax, you get profit after tax, PAT, profit after tax. So there is some tax that I will have to pay. So after that, whatever amount is there, I have my profits, and this is after all the taxation. I have this amount, okay, but life is not that easy. I should probably pay these guys who have invested in my company. I should pay them some amount, whatever I'm calling it as dividend, right? So the amount that I finally have with me after all my, even after all my profits are there, I have to pay dividends. So the final amount that I have with me, okay, is called retained earnings. So this is actually the final amount that you have. Your net income won't, you should remove the dividends from all of this, and then you have taxation, and finally you will have retained earnings. So more in depth we will have as we prepare prepare the statements, as we prepare the financial statements. But as of now, just remember these basic terms. So the next thing, I will stop the session here. Don't fret. And one more thing, okay? So the next topic is financial statements. So basically there are two financial statements here, okay? Two financial statements. But there are two others which will help us in a couple of places. So the most important financial statements are the income statement and the balance sheet. So financial statements or financial reporting are again of two types. They are into two categories. The first type of statements is a stock or a point. So it will report the status of the company at the specific point of time as of 20th Jan 2018 or 19, sorry. So as of today, what is the status of the company? This is a status or a stock report. But income statement, so this is a balance sheet. Balance sheet is a status or a stock report. So the second type of statement is a flow report. It will give you the flow of all the things that have happened during a course of time, during a period of time. For example, income statement for the month ending December 31st, 2018, or for the year ending December 21st, 2018, or for the month ending Jan 31st, 2019, right? This is for a period of time, and these are called flow reports. So what does the income statement give you and what does the balance sheet give you? This is for a point of time, this is for a period of time. What's the big difference, right? So an income statement will give you the list of all the expenses, revenues that you have made, and what is your net income. So that is given by the income statement. This will not give you things like I have bought this, I have bought equipment for the, say you bought equipment for the, I have bought 5 treadmills, okay. these things which are your assets, these things the income statement will not give you. This will purely give you your revenues, your expenses. Okay. Your balance sheet, however, this will give you your revenues, expenses, right? Your balance sheet will list out everything. It will tell you what your assets are, what your liabilities are, what are your accounts that you have to pay, what are your accounts that you have to receive. Okay. All these things on the balance sheet they will point out. Accounts payable is accounts amounts or accounts that you have to pay. Uh, for example, you have taken a service or a product in advance. Think of this like your, I don't know, your parents or grandparents, if they have a grocery store, they go there and they have the list of all groceries. They just take it on a daily basis, and that guy will note it down. This person has taken these many things from me, and during the course of the month, at the end of the month, he'll give you, hey, this is what your charges, this is what you have to pay me. So after I have taken those things, I'm not paying for the products yet, right? I'm not paying yet. So those are my accounts payable. I'm enjoying the service, but I'm paying it. And in the same way, there is accounts receivable. Okay, accounts receivable is where you are giving them the service, you are giving them the service or product, but you are yet to receive the payment for it. Okay. Think of it like Airtel or Jio give a postpaid. They're giving you the service. Okay. They are yet to get paid for it. For you, it's accounts payable. For them, it's receivable. So, okay, not to divert. We will have a lot of that in depth later. The next thing is cash flow statement and retained earnings statement. So retained earnings statement is relatively very simple, as the name itself suggests, like we just discussed here. Okay. This is basically whatever net income that you're getting and removing the dividends, and then you have whatever you have retained earnings. But there is a little bit of application that you have to do. Retained earnings for this year. Okay. Retained earnings, what did we talk? Retained earnings is, I'll briefly, okay, I just can't cruise through. This will give you your retained earnings, as the name itself suggests. Okay. Retained earnings is basically what? Whatever your revenue is minus expense, right? So that is if you're calculating it for that specific year. Okay. If I have started the company at the end of the year, my retained earnings are this. However, if my company has been like for 5 years, my retained earnings for the 5th year will be retained earnings for the 4th year plus revenue of 5th year minus expense of 5th year. Makes sense, right? Sorry, retained earnings of 4th year plus revenue of 5th year minus expenses of 5th year. So basically you add up the retained earnings of the previous year. And finally, coming to cash flow statement. You might ask me, you have a freaking income statement there, why do you need a separate cash flow statement? Yes, we need a separate cash flow statement because income statement will not give you all the transactions that are happening in cash. It will list out, these are my revenues, these are my expenses. That is what an income statement will give you. But a cash flow statement will list out all your cash transactions and how the cash in the company has been moving. As the name suggests, cash flow statement. Okay. So these are your different financial statements. Expect at least one, to do at least one of each. Practice all those exercises. Okay. And I want to finally, I will end the session with something called the basic accounting equation. Now that we have discussed so many things, we have discussed liabilities, we have discussed credits, we have discussed assets. This is the basic accounting equation. So, we have discussed the three operating modes of a company, right? So, I have my assets on one side. How did I get these assets? I got these assets through loans, right? These are my liabilities. These are my liabilities. And how else did I acquire my assets? By selling shares. So, plus shareholders' equity. That's it. This is the basic accounting equation. So, we will expand this further, because shareholders' equity, how did we actually get it when we are writing it as this revenue plus thingy? We wrote it as revenue. So how did we actually we gave some dividends, right? So revenue minus expenses minus dividends. Why minus revenue? Okay, shareholders' activity is revenue minus expenses are gone, but why did we also remove dividends? We already gave it back to the shareholders, right? So it can no longer remain the shareholders' equity of the company. So if you write it down, so it will come out as assets is equal to liability plus I'll write this as common stock. Common stock, okay, plus revenue minus expense minus dividends. So this is the expanded accounting equation. Remember the basic one and then you will be able to expand it. I'll cover more on this in the next session, and I'll also cover journals, ledgers. What? Yeah.